Hello and welcome to the second quarter 2017 market perspectives. My name is Matthew Adams, Chief Investment Officer at Mission Wealth. As we think about the key themes in 2017, quarter to date and year to date, it's been the story of a continued global equity rally. Domestic, international, and emerging market stocks have all rallied strongly in the first quarter of 2017, largely on optimism for potential corporate tax reform here in the United States and ongoing deregulation, particularly within the financial sector. Many measures of consumer confidence remain quite high, especially by historical measures, but we haven't quite seen the actual economic results catch up with investor expectations, but that may be coming still. In terms of the economy, we expect economic growth to be in the 2% to 2.5% range in the coming quarters. We'll take a look abroad. We'll take a look at our heat map and see how other countries are faring economically. We've seen some positive trends abroad. And then with respect to corporate earnings, we have seen some very strong corporate earnings year to date. We do expect that to continue to be strong, and we also see oil prices as playing an important role in that earnings growth, although we think oil prices will stabilize here. We'll touch on a rate and reality check, a few different categories here, but we'll talk about the Federal Reserve and their outlook for employment, inflation, and the economic growth. We do think that there are more Fed funds rate hikes to come here in 2017. We'll talk about the yield curve. Interest rates are on people's minds. We'll talk about the yield curve flattening, and we'll also talk about what forms of fixed income tend to produce better returns in a rising rate environment. And then finally, politics are definitely in the news these days. There's the recently announced White House proposal on tax reform, and we'll touch on a few topics there and see what may be likely. Okay, as we turn our attention to the first topic, the global rally in equities, we see that U.S. equities gained 6.1% in the first quarter. EFI, or a measure of international stocks, gained 7.4%, and the big winner was emerging markets and Pacific ex-Japan, both solidly into double digits for the first quarter. That global equity rally certainly may have gone in the face of expectations for many investors, given the geopolitical and the political issues under consideration. We saw that the trends in the strong dollar, U.S. dollar, have somewhat begun to abate in 2017, and that did allow U.S. dollar-denominated international holdings to perform better. So that's been a reversal from prior quarters and even prior years. And emerging markets, very strong performer despite the geopolitical concerns out there. The border adjustment tax, which had been in the news for many months and now seems to not be a part of the White House tax reform proposal. But ongoing tariffs are certainly on the table, and despite those concerns, many international countries performed quite well so far in 2017. Taking a look at the consumer, we mentioned consumer sentiment is quite high. The chart on the left demonstrates that. Had several months now at what would be considered extreme highs in terms of sentiment indicators. That's financial sentiment indicators. Similarly, we have a rotation index, which offers a view on how investors are favoring either risk-on assets like equities, or whether or not they are in preservation or risk-off mode, where they might be favoring fixed income. We've been solidly into a trend here where investors have been favoring riskier assets, such as stocks. So we expect that trend to be longer dated, and you can see the 6-month trend line within this chart. We talked about volatility. The VIX is commonly referred to as the fear index for the S&P 500 and the options that trade underneath. A reading of 12 is really quite low by historical measures, by any historical measures, and it's a very low reading over the last 3 years indeed. So again, despite what's going on in the news cycle and the geopolitical concerns that seem to dominate, the financial markets are relatively in a period of calm and low volatility. Taking a look at our key forecast for 2017, the remainder, what we see is that global equity markets have rallied quite a bit towards the end of 2016 and on here into 2017. Valuations are above normal. If you look at PE ratios, cyclically adjusted ratios, but valuations are not necessarily stretched. And we do think that they make sense in relation to fixed income. So we see fixed income yields here of 2.3% in the United States, 0.3% in Europe, and 0.1% in Japan. So in relation to those lower risk-free rates, the equity valuations for the global stock markets, we believe, makes sense. We do believe, as you can see from this chart, that over time, interest rates should begin to be moving gradually upward, and we'll talk more about that in the Federal Reserve in later slides. But we do think it is an environment to be prepared for a rising rate environment. As we think about currencies, we do think that the dollar is still the global currency of choice. We think that the dollar rallies further against the yen, the euro, and the pound. As we turn our attention to commodities, energy, precious metals, a little bit of a mixed bag there, but despite the strong rally in precious metals year to date, we do think that those tend to cool off here and stabilize, and likewise with energy. And we'll touch on the energy sector later, but we do think the price of oil should begin to stabilize in this $50 range. Okay, taking a look at some specific economic data points, we see that the U.S. economy is likely to grow in the 2 to 2.5% range over the coming, let's call it 2 years. We have seen an uptick in inflation measures approaching the 2% range that the Federal Reserve is targeting and comfortable with. That is certainly an increase over the 2014 and 15 lull where we saw the impact of energy prices have a downward effect upon inflation. Turning our attention to employment, we continue to see relatively great news there. Initial jobless claims continue to fall. The unemployment rate is well under 5%, and we believe on its way to 4.5% as we think ahead to 2018. We mentioned the global heat map. This is a chart that we've shown a few times before, but demonstrates the Global Purchasing Managers Index in manufacturing for not only different regions, but specifically for different countries. What we notice here is that developed markets have had a bit of a stronger ride in recent years with respect to economic activity, and we're still getting a good reading there out of developed markets of 54.6, and anything in green indicates an expansive and economic environment. So emerging markets have made their way into more of an expansive territory. There's still room to grow there. As we turn our attention down into the individual countries, what draws our attention is in particular is the Euro area, showing a reading of 56.2, and specifically Germany being the top reading here with a reading of 58.3. Most countries are in an expansive zone at this point with a reading over 50. And so, the global economic recovery continues to chug along here and is being aided a little bit further by expansive monetary policy, we believe, in Europe and Japan and other countries. As we turn our attention to corporate profits, the chart on the left demonstrates the expectation that corporate profits will continue to make record highs in the quarters to come. Those are the S&P analyst forecasts, the consensus forecasts. The chart on the upper right-hand corner demonstrates the anticipated path of energy sector earnings. So after the lull in earnings and actually some negative earnings through 2016, based upon the price of oil, we see energy sector profits returning here in 2017. And so that should be a contributor to the overall S&P 500 consensus earnings estimates. The bottom right-hand chart paints a little bit of a mixed picture in that we do see the number of active rigs within the United States increasing from that lull seen in 2016, and the number of rigs coming back online has increased. So the supply of oil being produced in the United States is growing, and this is a really testament to the technology and the economies of scale that we're seeing within the U.S. energy sector. So with more oil coming on board in terms of supply, we would expect certainly the price of oil to stabilize. There is certainly a strong underlying economic demand within the global economy, and we saw that on the heat map prior to this slide. But with supply coming back on board, we would expect energy prices to essentially stabilize in this range, around $50 a barrel. As we move towards our first reality check, this has been in the news quite a bit. We've recently seen the White House proposal on tax reform. The charts here demonstrate current forecasts out of the Congressional Budget Office and their baseline assumptions. The chart on the upper left-hand side demonstrates the total amount of government spending that we have of $4 trillion per year. The bar chart directly adjacent on the right demonstrates the sources of financing, or how we raise the money to pay for the total spending in the United States governmental system. And the part that immediately draws our eye is certainly the borrowing. We're currently borrowing $559 billion forecast here for 2017. And the chart on the upper right-hand corner kind of shows you how that cumulative accumulated debt compares to the size of our economy. So at this point, looking ahead over the next 10 years under current tax law, we're expecting the levels of debt compared to our economy to rival that of World War II. And this does not take into account any of the tax cuts or fiscal stimulus that are on the table at the moment. The bottom right, left-hand chart and table here shows, again, the Congressional Budget Office's baseline assumptions. And, you know, the real GDP growth is really the line to call your attention to. So about 2% growth forecasted here in the next year or two. And then that begins to slide to, let's call it 1.5% the following 2 years. And then, you know, longer term, right back around 2%. So the entire thrust of the White House tax reform proposal is to move this number. So 2% is definitely below the long-term capability of our economy to grow, and we have had historical numbers that are much higher than that. We'll take a look on some subsequent slides here as to how we might be able to move the needle and get growth closer to 3%. But many of the White House proposals are essentially saying that this could be a tax-neutral policy and tax reform if we can get the economy growing at 3% or higher and collecting that much more in terms of revenue from income tax. So this is a classic supply-side tax cut, and it is problematic that our economy is only growing at 2%. So we'll see if we can grow faster than that. So as we discussed, we're looking to grow the economy at closer to 3% based upon the White House's proposal, and there's multiple proposals being discussed within Congress. But as we take a look at the drivers of GDP growth on the left-hand chart, what we see is that in previous decades we'd achieved 3 and 4% economic growth fairly routinely. There is two major components of that GDP growth. In the blue, we detail the growth in the workforce, so simply the population growth of the United States. And then the light gray here is the growth in the real output per worker, or their efficiency. How much more are they producing given the existing capital stock that they have to work with? The White House proposal and many of the tax cut proposals at this point are focusing on the gray section and saying if there is a way to make workers more productive and encourage companies to reinvest in them to produce more, then perhaps we could improve the 0.9% reading that we've had in the past decade and get that running closer to 2%. So if productivity were growing at closer to 2% and we had some population growth of, say, 1%, we could conceivably achieve that 3% number. So definitely moving the output per worker or the efficiency per worker is a critical part of this economic recovery plan and something that makes good sense. In terms of the upper right-hand chart, we see the growth in the working age population within the United States. And we can see that in the last decade, from 2007 to 2016, we've simply had slower demographic growth. This is certainly to do with the baby boomer generation gradually phasing here into retirement, But the concerning number is as we look ahead from 2017 to 2026, that the population growth in this working age class actually decreases, and decreases dramatically. It drops from 0.6 to 0.3%. So this census forecast here demonstrates the two components of that, both immigrant and native born. And of the 0.3% population growth expected over the next decade, the majority of that is actually from immigrant growth. So, highly important to make sure that immigrants enter the country legally and are productive once they're here. But it does cast a picture on the importance of maintaining America's openness to immigration and making sure that we attract the world's most talented and brightest workers. Another reality check, we talk about the Federal Reserve. We talk about interest rates rising over time, and I think this chart does a nice job of demonstrating the pace at which the Federal Reserve is anticipating to increase rates. The main table that I want to call our attention to is really the Federal Open Market Committee's forecast for long-run growth in the economy, their long-run target for unemployment, and their long-run target for inflation. So the Federal Reserve believes that the U.S. economy has a long-run target of approximately 1.8% economic growth. We're there. We've looked in previous charts, and we're running at approximately 2 to 2.5% over the next 2 years. In terms of unemployment, we're already at 4.7% unemployment, and that's expected to go lower to 4.5% in the coming years. So that checks the box that the Federal Reserve is looking for. And then finally, in terms of inflation, inflation target is 2%. We're right there. We're currently at 1.9% and close enough, certainly, for government work. So as we take a look at the FOMC year-end targets and the dot plots per se, you can see the path at which the Federal Reserve expects to be raising interest rates. It's called over the next couple of years, they're expecting to move to 3%. The market expectations are a little bit lower, but still on the same upward trajectory, expecting the eventual end game to be somewhere closer to 2%. So regardless of the market expectations or the Federal Open Market Committee expectations, the trajectory is upward. And so as we take a look at some previous tightening cycles, we can take a look at the last 6 on record. And what we see here is that the tightening cycles are denoted within the gray sections of the upper chart. And on average, there are typically 9 rate hikes per tightening cycle. Also on average, the Fed funds rate has risen by approximately 3%, or 308 basis points to be exact. And market-driven rates are just that. They are market-driven. And the 2-year Treasury has risen by 2.4% correspondingly to these Fed rate hikes. And the 10-year Treasury has, on average, increased by 1.3%. So there is not a perfect correlation amongst the different market-driven interest rates, but there is a strong correlation, and it is a positive one. So we are expecting the overall interest rate spectrum to be increasing. We're looking forward to what's known as a flattening yield curve, and we're taking investment directions to handle such an environment. Next slide here shows the impact of a 1% rise in interest rates. The top portion of the chart shows the impact on U.S. Treasury bonds, both 2-year, 5-year, TIPS, 10 years, and 30. And the total return in bluish green here is, for different maturities for a given 1% rise in interest rates. And this assumes what's known as a parallel shift in the yield curve and steady spreads. So the bottom half of the chart demonstrates the types of fixed income that are more resistant to a rising interest rate environment, including convertible bonds, U.S. high-yield corporate bonds, floating rate, mortgage backs, corporate bonds all do better across the spectrum than their purely duration or interest rate specific cousins here on the sovereign side. So the moral of the story here is that not all forms of fixed income will react negatively to a rising interest rate environment. So we here at Mission Wealth have been building our allocation to these less interest rate sensitive forms of fixed income that have nice solid yields to them And so with that, that is one of the actions that we took here in the first quarter. With the drop in the U.S. Treasury below 2.4%, we took the opportunity to take out one of those more interest rate sensitive asset classes, which is high yield municipal bonds. And we put in one of the lower interest rate sensitive investments, which is U.S. corporate high yield bonds. So again, that decision was based upon our belief that that interest rates should be rising in the forthcoming years, and taking the Federal Reserve at its word that it will continue to raise the short-term rate. Also in the first quarter, we rebalanced equities, domestic equities in particular, getting definitely overweight within our portfolios after a strong run over particularly the last 3 years. So using those proceeds from domestic equities in general to purchase lower volatility asset classes such as fixed income, replenishing cash levels for some clients, and buying some alternatives. Looking ahead, our expectations include this rising rate environment, and we think that the potential corporate tax reform and personal tax reform issues will be front and center for many, many months here to come. We are also certainly keeping an eye on the geopolitical and economic developments, and we do believe it's important for our clients to maintain a globally diversified portfolio that can weather some of these country and tax form specific risks. So, with that, we really appreciate your attention to this market perspectives. And should you have any questions, please don't hesitate to contact your client advisor. Okay, thank you very much. Talk to you next time.